next? Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
And welcome. You're listening to the Financial Survival Network, and it is November 17th, 2014. And we are speaking with John Rubino of dollarcollapse.com. Growth has always been the byword of the economy because, let's face it, when you live in a world where central banks print money, you have to have growth because you're always required to pay back more and more interest. Interest increases at a geometric rate. Eventually, well, you have the money bubble. John, welcome.
Morning, Kerry. Yeah. We had some growth numbers come out in the last few days that kind of imply that the whole world outside the U.S. is dropping into recession or pretty close to it. Japan is flat out in a recession now, technically, because they've had 2 quarters of negative growth. And the last one was a surprise that they just announced over the weekend. The economy is now shrinking at an annualized 1.6% rate. Which kind of explains the massive increase in quantitative easing they just announced. You know, these guys saw the numbers ahead of time, and they figured they better do something serious to head off some kind of market collapse because their stock market is at record levels thanks to previous quantitative easing. And for an economy to drop into recession at a time when the stock market is at a record level means the stock market's going to follow the economy down normally, because corporate profits drop, which makes equity valuations less attractive, which makes stock prices fall. And so that's what they were trying to head off. And they may not have succeeded because the Japanese stock market tanked last night. And meanwhile, China just announced that its bad loans in the official and shadow banking system jumped by the most since 2005. And that means that their credit bubble may be bursting. In other words, they borrowed and lent so much money in the past 5 years, and that's a big part of what pulled the global economy out of the Great Recession of 2008, 2009. But a lot of that was malinvestment. It was debt that shouldn't have been taken on in the first place, and now a lot of the companies that borrowed that money are going bust, which means China has a pretty big issue to deal with here. And last but not least, the Eurozone just announced GDP for its constituent countries, and in the aggregate, the Eurozone is only growing by 0.6%, and a lot of the constituent countries are in recession right now. And France, while it's growing slightly, announced that it was going to miss the deficit targets again. It hasn't made its deficit targets for 6 years now straight. And now it says 2017, it will be able to adhere to the Eurozone deficit rules. And that's probably a fantasy too. So France is going to have to, along with the rest of the Eurozone, start inflating aggressively in order to get their economies growing again. So you look around the world, and everywhere, after 5 years of really aggressively expansionist monetary policy, with the exception of Europe, everybody is starting to shrink now. It didn't work. Quantitative easing did not work around the world. And so the question is what happens next? And I think it's pretty clear that massively increased quantitative easing is what they're going to go with next.
Well, in China, though, they were talking about actually cutting taxes. Right? Did you hear that? They said, hey, we got to cut taxes. I think that's like the supply siders in China coming out.
Yeah.
And I think they'll last for about 5 minutes. I think they're going to be shot down because, where we know that cutting taxes, cutting regulation, cutting government is a proven method of dealing with this. I just don't believe anybody's going to do it. Certainly we aren't doing it in the U.S., are we?
Yeah. Well, and even if they do it, they have to borrow to make up the difference, at least in the short run. So net debt goes up dramatically. There's really not much you can do once you've borrowed too much money, because any policy option, whether you try to, grow aggressively or you try austerity where you cut back on spending, whatever it is, runs into this brick wall of too much existing debt. And that screws up your plans. And so that's what the whole world is dealing with right now. So most of the world has fallen back on monetary policy because fiscal policy, the previous deficits of the last 30 years have resulted in huge amounts of debt. And so that looks like a political and economic non-starter for most countries, going back to supply side policies.
Well, what I'd like to understand here, is gold prices past 2 Fridays. Now, understanding the market's completely manipulated and you can't believe anything that you see. But nonetheless, the past 2 Fridays in a row, John, gold prices spiked substantially. 37.50 or thereabouts the week before last, the Friday before last, and 28 and change last Friday. I don't know if they're connected or if the boys are back in town playing games. I don't quite get it, but I don't believe in coincidences either here, John.
Well, volatility is really picking up in the gold market, as it is in all financial markets, including equities. But now you're seeing big up moves and big down moves in precious metals, and they're kind of reversing each other out. And a lot of the time, that's precursor to a big move in one direction or another. The analogy that James Turk and I use in the Money Bubble is a spinning top. You spin it and it spins really smoothly for a while, and then a wobble kind of sneaks in, and the wobble gets bigger and bigger before it just shoots off in one direction or another. And financial markets tend to work that way. Volatility goes up for a while as the markets are nervous and they're trying to figure out whether they should be optimistic or pessimistic, and huge amounts of money are flowing in and out. And so you see big moves in both directions, which is when you should have a volatility spread on with options. You can just see it coming ahead of time. But so the question with precious metals, I think with equities, I would say that the volatility now is a precursor to a major market correction. But then, of course, I've been saying that for 2 or 3 years. And with precious metals, I'd say it's the opposite. It's already been crushed. And so this kind of volatility might be a precursor to a big up move, because the fundamentals are just phenomenal for precious metals. You've got Japan ramping up QE at a rate that translated into an economy the size of the U.S. would be about $3 trillion a year. And you got Europe having no choice but really aggressive debt monetization. These are phenomenally good circumstances for something like precious metals and real assets in general. And then you've got the Swiss referendum at the end of the month, when they're going to vote on whether to require the Swiss National Bank to buy a lot more gold in the open market and never sell it. Which would be,
and get their gold back from these fiduciaries, which is a trusted party, which we'll find out who you really can trust in this world and who you can't.
Yeah, and they'll find out a lot of the gold's not there, and it has been lent out. And so there will be this huge scramble to get enough gold to satisfy the demands of the Swiss National Bank should this thing pass. And so you put all that together, and you've got a lot of people thinking, well, maybe now's the bottom in precious metals. Let me buy some. And that's spiking the market. Yeah. And then you've got the guys playing the paper games on COMEX and elsewhere, knocking it back down. By selling huge amounts of futures contracts at weird times, like when the Japanese market goes out to lunch, they dump $1 billion worth of gold futures there. Things that you would never do if you're trying to get a good price for your futures contracts. So you have these two big forces now contending in precious metals, and we'll find out which one wins in the end. But I think there's a pretty good chance that finally the good guys are going to win.
Yeah, I think something else is afoot there. I'm not pretending to know what, because I've called about 6 out of the last 2 bottoms in precious metals, right? So, dangerous work. I'm just kidding. I haven't really I haven't attempted to call any of them, because you really can't until they're in. Some people are better at it with the cycles and all that, but me. Not my purpose to call tops and bottoms. I leave it to other people. I really thought the bottom was in silver for sure, and now it's at $16. So it shows what I know. I thought it was in at 18, but you know what? Production. Look at the miners. They are just standing on their heads, spitting wooden nickels. Now they're in such dire shape.
You have Andy Hoffman on, who does some really good research on the mining sector, and he says a 25% drop in silver mine output in the next couple of years is no longer possible, but likely at these prices, because so many silver mines are just going to have to close down, because they're all in sustaining costs. They're like $22 an ounce, and selling silver for $16 an ounce is a really quick recipe for bankruptcy. So they're just...
You always have to remember this when it comes to silver, is that most of the production that comes out, there's very few pure silver mines out there, byproducts of copper and lead and zinc and all that. So, but for the ones that are out there, like Pan American and our guys at First Majestic, who's really sharp guys there, and who was it, Fortuna, they're just like, forget it. They're really efficiently run silver mines, and they can't make money at this price.
And then you've got all these juniors and these exploration companies that would have been bringing mines online in the next couple of years to make up for the big mines that are running out of resources. And they're not going to be able to do it. In a lot of cases, they won't be able to do it. They either won't be able to get financing to put the finishing touches on a mine, or they've got the financing in place, but the mine can't operate profitably. So what's the point? So you'll see a lot of these guys just cancel their plans or mothball their mines or whatever. And so production will not be what it would have been, what it's been projected to be going forward. And, that's another positive for silver prices. Meanwhile, you got solar energy, which we talked about last week or the week before, just ramping up all over the world. And solar panels use a little bit of silver in each solar cell. Yeah. And that is a new source of demand, which potentially in the next few years could get up to like 20% of global mine output. And so you bring in a major new source of demand at the same time supply is going down. And, fundamentally, that's a good thing for prices. So I don't know. You can talk yourself into mortgaging your house and buying silver.
Yeah, not a
by
good
looking
idea.
at just the fundamentals. Yeah. What hasn't been a good idea in the last few years, that's for sure. But it sure does look like a $50 metal at some point in the not too distant future. And I don't know. I wouldn't. Obviously, we shouldn't recommend that people load up when the price action is this weird. But at some point in the next decade, people are going to look back at this price and say, "Oh my God, I should have loaded up.
Coulda, shoulda, woulda.
Yeah,
man, why didn't I do it?"
Yeah. Question is, what happens in between now and then? Does it go to $7 an ounce before it goes up to 50 and 100? I don't know.
Yeah, doubtful, but one never knows, because it started this rally at $4 or $5 an ounce. And who knows? But hey, when we get back, so let's talk about what's happening with collectibles, what's happening with that Patek Philippe watch and that painting, that Warhol, on the Financial Survival Network.
FSN Radio. It's all about what's next.
Every week the show is growing. Would you like to be a part of it? Then go to clubfsn.com and help support us with $1, $2, $5, or $10 a month and get a host of premium content with newsletters dropped into your mailbox, free books, private audio clips, webinars, and much more. Then join clubfsn.com. If you want to get ahead of the trend and ensure your family's financial security before it's too late, go to clubfsn.com and sign up.
The Financial Survival Network. It's all about what's next.
Hey, in case you just joined us with our Monday morning chat with John Rubino of dollarcollapse.com, co-author of The Money Bubble. And John, so like collectibles and other distractions of the 1/10 of the 1%, the super wealthy, are just going like nuts. I mean, $24 million for a Patek Philippe watch, a pocket watch. Now, granted, it was like the most complicated, complex pocket watch ever made. Patek Philippe actually had to subcontract it out. It was so complicated, they couldn't do it themselves. But nonetheless, I mean, this thing is nuts. And then you got the Triple Elvis by Andy Warhol. Now, I was never a real Andy Warhol fan. I mean, Campbell's soup labels, but somebody likes the guy, and 80 something million for that one. And, condos in New York City going for 100 million. And, whereas on the other hand, you have deflation, where you have, price of a barrel of oil is down to $75, which is really huge.
Well, we started our talk with how slow the global economy is outside of the U.S. and how many big parts of the global economy are dropping back into recession. And yet, at the same time, the richest people in the world have more money than they know what to do with, obviously, based on a lot of this stuff, because they're out there just paying insane prices, relative to historical levels for doodads, knickknacks, shiny objects. And the latest Christie's contemporary art sale is a great example of this. The auction house just set a record of $852 million for a set of paintings that it sold, which was higher than the estimates and higher than the previous record of $745 million. And as you mentioned, the stars of the show were Andy Warhol's two paintings that were on sale. And on the second painting, when it closed, the audience was so stunned. I guess apparently normally they cheer when there's a big price, when a big price is paid for an object. And they were so stunned they didn't even applaud. They just sat there because they couldn't believe the price that was being paid for this thing.
Because they realized, hey, maybe we're not as wealthy as we thought we were, right?
Yeah. And what this means is that the richest, most sophisticated people in the world no longer want to hold financial assets. They got this currency, or they've got stocks and bonds or whatever that they want to get out of because they don't believe that financial assets are attractive anymore. And so they're buying real things that exist in limited quantities and can't be made in infinite quantities by governments. Things like art and, as you said, penthouse apartments and farmland and other kinds of real assets. And they're paying basically any price they have to get them. Mm-hmm. And what that means is that this is the cutting edge of a coming inflation, I think, because we're seeing the smart money shift out of financial assets and into hard assets in a big way, in a really aggressive way. And that idea is going to spread as more and more people figure out that the currency that they're holding is being aggressively devalued by their government. I mean, it's Japan's explicit policy to increase the rate at which the yen loses value, right? Mm-hmm. The Eurozone now has to announce the same thing because they're in danger of dropping into deflation where their currency actually gets more valuable over time. They can't have that because that makes their debts more onerous. It'll destroy them if the euro actually goes up in value. And so they have to explicitly devalue the euro some way, somehow in the next few years. So people are going to figure this out. And as they figure it out, and as the activities that we're seeing in the 1% now go mainstream, middle-class people start figuring out that this is what they should do. They're going to buy hard assets that are available to them. They'll look at attractively priced real estate and of course, precious metals. This is the segment that usually benefits from a shift out of financial assets into real assets. People buy gold and silver coins, or they if they've got more capital, they buy gold and silver bars and have them stored in a safe vault somewhere. This is what happens. So we would expect to see this spread over time as it becomes obvious that government policy is etched in stone now. The dollar and the euro and the yen are going to get less and less valuable over time. So why hold them? Take them, convert them into real stuff that governments can't devalue, and expect those real things to appreciate over time in terms of local currencies. So, yeah, that's our future.
Yeah, I think you're right. And I think that you have to look at strategic use of leverage as well, right? Because if something's going to become, a currency is going to become worth less, then if you can use leverage and it's an income producing asset like apartment buildings, such things as that, and income producing real estate.
Well, see, that's the really, I mean, it's an obvious logical conclusion, as you said, but that's the really destructive thing about easy money is it convinces people to use as much leverage as possible because they're going to be paying back that loan in a depreciating currency. But you get people going overboard.
Oh, yeah.
And investing in things that they shouldn't invest in using borrowed money, and then you build up the conditions for a huge collapse. And we've been doing that for 30 years. We have a world of malinvestment out there already. Yeah. And so what we're going to do now is ramp up the process by encouraging people to borrow even more aggressively, because they know the currency is going to depreciate for the next decade. And that can't end well. No. From a Keynesian perspective, it's a good thing because you get immediate growth, and they don't really look at balance sheets or what's being invested in. There's the old Paul Krugman statement about, if we were invaded by aliens right now, that would be good for the economy because we would ramp up military spending.
Hey, broken windows, man.
Yeah, the broken windows theory, and of course. Good. Military spending is not a wealth-producing activity. And so in the long run, it makes you poorer if you buy a bunch of things that you're just going to blow up or not, and let sit on a military base. And yet that's not well understood by the guys running things. They're looking at next year's growth and the amount of money that people are willing to borrow and spend. And to them, the more the merrier. The more you borrow and the more you spend, the better life is for everybody. And yeah, it's true this year, but it's not true 10 years from now. And so anybody focusing on the long run tends to see this as crazy. And once they realize that, then the logical investment play is what we're seeing from rich people right now. Get out of that currency as fast as possible.
In the long run, we're all dead, as Keynes said.
The corollary to that is that Keynes is dead and we're living in his long run and suffering from the mistakes made back then. So, yeah.
But you got to look and you got to say, you got to get through it and you got to figure out a way to do it. What's the best strategy? Do you want to have everything in precious metals? If you did the past 3 years, you were not a happy camper. But on the other hand, who's smart enough, John, to be moving in and out of things? Only Martin Armstrong, not the rest of us, right?
Yeah. Trading is a professional's game. And even then, it's incredibly hard to do. So the fact that bubble markets tend to go on longer than a rational observer would expect them to is really frustrating because you can't really... you make the rational move, and it turns out to be 3 years too early, and you get creamed for 3 years before it works out, and then maybe you just make your money back if you're lucky, And so timing is everything with bubbles, and timing is impossible to call with bubbles. And I don't have a solution.
Actually, there is. I'm just reminded of what Howard Katz, who used to publish a publication before he passed on, used to say. It was called The One-Armed Economist. And he used to say, in a depression, all you want to do is not go broke. Everybody gets poorer. You just want to keep what you have. And if gold and silver enable you to do that, then you won. Anyway, we got to go find John's work at dollarcollapse.com. Buy his book that he co-wrote with James Turk, The Money Bubble. And we've got a link to it on our site as well, financialsurvivalnetwork.com. Don't forget our free webinar coming up November 25th this year, 9 p.m. Link is on the site. Check it out. And John, we'll talk to you next week.
Thanks, Kerry.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.